Hello everyone and welcome to Nettle, the best platform around for distance learning in business, finance, economics and much more. My name is Sava and today we are continuing examining simple option trading strategies. Last time we discussed what to do if you are bullish given a particular stock price, what to do, what options to trade if you believe that the stock price will go up. We discussed the long call strategy, the short put strategy, and how they correspond to different beliefs about market volatility. What to do though if you believe that the share prices will go down? To do that, let's consider a very famous case study regarding a well-known British oil company, Tullow Oil, that has been going through some rough times. So they have been underperforming in terms of their profit announcements. Their CEO has quitted, and it's pretty much easy to forecast that the share price is going to be at a downward spiral from now on. So let's consider that we are again on the 13th of January 2020. We basically are just at the spot when the CEO quitted, and we have options available to us to trade at maturity date of the 25th of February 2020 again. And we can expect the share price to further plunge below the current level. So in case of this particular company, we can utilize two of the bearish option trading strategies. So if you are bearish regarding your market forecast about a particular company's stock price, you can either go for a long put or a short call. Let's examine first the incentives of an options trader, whether they go for a long put or a short call. Obviously, if you long a put option, it is not exercised out of the money because, well, you could have sold for a better deal on the market. But if the price falls below the strike price, you can profit as much as the share price have been decreasing. So if you have the opportunity to sell at the strike price and the share price moves below that, your payoff will be determined by how much the price has decreased below the strike price. And in case of the short call, well, in case of the short call, you are basically betting on the stock price to decrease as you are obtaining the premium, and you would have to exercise your counterparty's right to buy the stock from you at the strike price if the price goes up. But if it stays the same or goes down, then the option would not be exercised. Your counterparty will allow it to lapse, and you will just get away with getting the premium and not providing anything for the option contract at all. So that's the two strategies you can easily go with when you are bearish, when you believe that the stock price will go down. So first, let's examine the starting share prices, so the center price of Tullow Oil, and options that are available for trading with regards to long puts and short calls. In case of those other two simple option trading strategies, you are also aiming at selecting your strike price to be as close to the center price, so to the share price at the start of your trading period, as possible. So at the start of the trading period, the stock price of Tullow Oil was 62.3 pence per share, and options for Tullow Oil are available for trading at increments of 5 pence. So you would be talking about 55, 60, 65, 70, and so on and so forth. So it's easy to determine that the closest strike price to the center price is 60 cents per share, because, well, 62.3 is a little bit close to 60 than it is to 65. So let's stick with that and investigate what are the premia of a long put option at 60 and short call at 60. So again, if you are long in an option, you need to consider the ask price. That's the price you can buy the option for immediately by launching a market order. And for the short call, you need to consider a bid price for the call at this particular strike price, as that's the price you'll be able to sell the call option immediately, given the current limit orders that are in place on the market. So the premium of the long put at 60 pence per share is 6 pence. The premium of the short call at the same strike price is 5.5 pence per share. So let's consider again wide, yet not too wide, range of potential share prices. So let's go from 10 pence per share all the way to 120 pence per share. So being slightly symmetric and moving it 1 pence per share at a time. So let's consider the gross payoff of the long put. So if the share price is lower than the strike price, well, the put option is in the money. And we already know that put options are exercised in the money because we have the incentive to exercise the option that we are holding. We could buy the stock at the current market price, which is lower than the strike price, and then exercise our right to sell it at 60 pence per share at the strike price to our counterparty and benefit from the difference in those two prices. So our gross payoff will be just the difference between the price that we are selling the stock at and the price that we can buy it for. So the difference between the strike price, that's what we receive, and the current market price, that's what we pay. And if the option moves out of the money, well, put options are not exercised at the money, because even if we held the stock, we could have sold it for a better deal on the market rather than exercising our option for 60 pence per share. So our gross payoff is 0. What about the net payoff? Well, regarding the net payoff, in case of the long put, we have bought an option, so we had to pay someone, in particular the counterparty, the writer of the option that we are holding, for that optionality. So we need to subtract the option premium from our gross payoff to get to the net payoff. And then we can bottom right click it all the way down and see what the payoff structure of the long put is. So we can see that if the stock price goes down, we have ever increasing upside. If the stock price goes up, we have a limited downside that's determined only by the option premium we had to pay. So again, that's very similar to a long call, albeit just symmetrical around the strike price. We have unlimited upside when the price goes down, limited downside when the price goes up. And we can see that if the share price moves down, but only by a little, we start gaining in gross, but we still lose in net because our gross payoff that we get from the difference in share prices is lower than the option premium that we had to pay. Now, let's illustrate this payoff structure using our favorite option payoff chart. So again, bottom row, middle icon, scatter with straight lines. Again, we can format the axis to reflect only the range of stock prices we care about and see that obviously, and we can see that indeed the option payoff of the long put has an unlimited upside when the price goes down and limited downside when the price goes up. And that basically reflects our beliefs about the stock price movements. We do believe that the stock price will go down because, again, it's a bearish strategy inherently, but we also do believe that it will go down by a lot because, well, if it goes down by a little, we're still losing because we had to purchase the option at the ask price, at the option premium of 6 pence per share. So you're only gaining in net if the stock prices drop by more than 6 pence per share. So that's why the long put is a bearish high volatility strategy. So you're bearish on the direction of stock price movements, but you're bullish on volatility. You're expecting higher volatility. Now let's consider the payoff structure of a short call. So for the short call, we need to investigate what happens if the option is in the money. So what happens if the share price is lower than the strike price? Well, then call options are not exercised. And well, call options are not exercised in the money, that's clear, but let's consider what the incentives are of someone we have written the option to. Well, they could have bought tallow oil from us at 60 pence per share, but do they really want to? Well, if the share price falls below 60 pence per share, even if they wanted, they could have bought it for a better deal on the market, so they don't want to exercise it. And the payoff that would have gotten from exercising their option would be negative because they could have bought it at for 60 from us, and then they would have to sell it for a lower price on the market. So it makes no sense for them to exercise the option. So we are actually happy about it because we extracted the option premium from them and we didn't have to provide anything to satisfy their right to buy it from us at 60 pence per share. So gross payoff is 0. What happens if the call option moves out of the money though? Well, call options are exercised out of the money. Our counterparty has the incentive, they're interested in buying the stock from us at 60 and then selling it for a higher price that's currently being in place at the market. What it means for us though is that, well, imagine our counterparty approaches us and says, well, I have the right to buy tallow oil at 60 pence from you. And if you haven't got the stock price somewhere with you, you'll have to buy it from the market. So you'll have to pay the market price and receive 60 pence. So you're receiving 60 pence and you're paying the market price, which higher than the strike price. So it means that on gross, you are losing if your short call that you have written is exercised. And that's all there is for the gross payoff of the short call. So obviously we can see that if the share price is lower than the strike price, then the short call is not exercised and we get the gross payoff of 0. But actually the only reason why we would have written a call is to obtain the premium. So to get from the gross payoff to the net payoff in case of the short call, we need to add the premium of the short call to our gross payoff. And then we can bottom right click it all the way down and see what is the payoff structure of the short call. So we have a fixed upside when the price goes down and unlimited downside when the price goes up. So again, this is a very, very notable feature of option trading. If you long an option, you have a fixed downside and unlimited upside. When you short an option, you have a fixed upside and unlimited downside. That's why writing options is inherently more risky, because you can lose as much money as would be determined by the movements of the share price. But how are those two strategies different? Well, if the share price moves down, but by only a little, so for example, it drops down to 59, in case of the long put, we still lose 5 pence on net, simply because we had to pay 6 pence per share as option premium. But in case of the short call, we are immediately gaining the short call premium, and we don't have to worry about anything else. So if we plot the gross and net payoff of the short call, we can visualize exactly the same logic of fixed upside and unlimited downside. But what is more interesting is to visualize and compare the payoffs of those two options in terms of net payoffs and compare them, and that would help us to visualize what are the volatility beliefs of traders that engage in those strategies. So we can see here that if the share price moves down, but by a little, then a short call is much more attractive than a long put. But if the price decreases further down, then the long put becomes a much more attractive option due to an unrestricted upside. And that's all there is for simple option trading strategies. In the next videos, we would be discussing option spreads, so portfolios of options. You could, turns out, long or short multiple options at the same time at various strike prices, and that's how you can modify your payoff structure to make it more consistent with your forecast and with your overall beliefs about where the market will go. And for now, stay tuned